So once again, we have another big day of earnings that have just come out, and I thought I'd talk about some of the stocks that have reported earnings. We're about halfway there now. We're about halfway there. After next week, we'll probably be about 75% of the way there. We've got a lot of busy earnings coming next week, and I was actually going to do the Stocks I Buy November edition today, but I thought with a few of the moves that are going on in the market at the moment, I thought I'll talk about these, and then if I have time, I'll try and do the Stocks I Buy November edition for you guys. First of all, a stock that I actually missed off yesterday's video was actually Royal Caribbean, or Caribbean, depending on how you say it. This stock has been punished recently. Obviously, we've seen July time, which I think was around the last time the Fed hiked up the interest rates. We've seen the stock market tumble since then, and a lot of weakness and concerns around a recession. And Royal Caribbean, once again, was a kind of another company that came on the list and went, we're not seeing a slowdown. They came out with Q3 earnings and they were a smash on their estimates, and they also hiked up their full year profitability as well because of strong demand. So once again, it's really interesting out there, because what we're kind of seeing is that stocks that are more cheaper selling products are really not seeing that much of a slowdown, but where you see the kind of higher interest rate sensitive kind of companies where they're a little bit more expensive, you probably need to go get a loan or some cash, or you're more sensitive to the higher interest rates. We've seen all them kind of companies suffer, but all the ones that are more kind of based around you can pay that out without having to get a high interest rate loan are still doing okay. So it's quite a big mixture out there at the moment of what's kind of going on with some companies' earnings. And Amazon as well. Amazon came out their earnings, and what was quite surprising with Amazon earnings is they actually came out and the stock was up about 4%, and then the market actually sent it down again 4%, and then it went back up again 6%. I mean, this is some serious volatility we're seeing in earnings season, where we're seeing, I will look at Amazon's numbers in a second, but, really, really good numbers. And then we saw the kind of the reflection in the share price, and then it actually tried to send it negative, and then it goes back up again. This is really big volatility out there at the moment, guys. Like, I've not seen this for a long time, maybe ever, where there's this kind of volatility or trying to send these stocks down on really good numbers. And looking at Amazon's numbers, EPS of 0.94, they beat the consensus by 0.6, but the big thing is that obviously the Rivian investment obviously makes a big difference on that. So last year when Rivian stock was getting absolutely slaughtered, we saw that as a big headwind towards the EPS numbers on Amazon, but now this year we're seeing a bit more of a tailwind. So always a little bit unpredictable on the EPS front, but hey, it's a beat at the end of the day. Revenue up 12%, so back to double-digit growth, which is obviously really good. I think that was towards the higher side of the guidance that they gave last time. Amazon Web Services as well, up 12% year over year. Also on the fourth quarter guidance, not too bad on the fourth quarter guidance, and also operating income as well to be up to 7 billion and 11 billion compared to 2.7 billion in the fourth quarter of 2022. So yeah, a lot of things moving in the right direction for Amazon at the moment, and it's a stock that the earnings should have been up. I don't know why we saw a big jump and then a big down and then a big up again. It's been a little bit crazy out there at the moment with some stocks. The way we've seen some stocks move has been really insane in the last kind of couple of weeks. Enphase. Obviously, we'll talk about Enphase, because I know if you guys wanted me to kind of speak about this, because it was high up on my watch list. I really want a solar play into the portfolio. I think solar is massive in the next 5-10 years. Renewable energy in focus, and Enphase potentially could be that company. I add it onto watch list and see what kind of goes on with the business. I've got to say, I mean, YouTube is a funny thing. Like, in last kind of year or maybe even 2 years, I didn't realize how many people are either very bearish on the market now, because I feel like maybe they've been destroyed in the market in the last 12 months and now they've gone to be bearish on it, because they just got used to it being down. Maybe the new investors, and they've just got used to a market being down all the time, or just generally people don't like you and like to put hate on the internet, or just have terrible lives where they go home and the missus shout at them all day and they need to take the anger out somewhere, and they come onto YouTube or something. But generally, I don't realize, I didn't really realize the amount of hate you would do for doing YouTube videos, and that's what it's been like in the last kind of 12-24 months, is that the comments I get is unbelievable. But the stuff that gets said about you is absolutely insane, and like even like the lies that gets told about you. Like I've covered Enphase before, and like I said, you know, it's a stock that I'm watching if it comes an interesting opportunity. And like the other day I talked about it, and like there was loads of people in the comments like going, oh, he's buying Enphase and he's down 50% on it. I was like, when did I say I own Enphase? When have I ever said that I bought it? At what point has it been in a portfolio review? And it's, you got to be careful out there, guys. You know, there's some really strange people in the comment section, and some people that also like telling a little bit of lies about you in the comment section. So just be a little bit careful out there. But Enphase, obviously, I mean, probably the most predictable earnings move. You know, I think on it was Monday I called it. I said that Enphase is, I think it's going to have a horrible earnings. I think it's going to be down close to 20%, and it's down nearly close to 20%. You know, it's one of those where you go, should you put like a short position on it? And you've been doing well from it, but you never know with earnings. You know, you never know with earnings. You know, you look at InMode, you know, it looks like a guaranteed that it will go up, and then they come out and miss. You know, you can be in for a shocker there, but it looks quite obvious because, you know, like I said earlier, any high interest rate sensitive company that you need to buy the product and take a high interest loan out is suffering at the moment, and Enphase is that, and they're struggling. And we saw the numbers with Solar Edge. We saw that, you know, the European growth was now weak as well as the US growth, and that was clear in Enphase's numbers. It was so predictable, and it also makes me laugh that, you know, the amount of times that you can get something wrong, you say this and you get something wrong about it, and you make maybe a suggestion on stock and it goes, you know, down or something, and then you make a right call and, you know, you get no credit for it. It's really funny in the YouTube scene on that point of view, you know. But hey, and you know, the thing with Enphase is that you look at the demand that was pulled forward because of the energy crisis in 2022 and the low interest rate environment. They've got some tough comps, and it's kind of a bit of a learning curve from like the CV times. When you see that, you know, when you look at the likes of Boohoo, for example, and it had all that demand pulled forward, you don't really realise how much demand's pulled forward until it, you know, you start lapping the comps and like, oh, that's really tough numbers. And the problem with Boohoo now is actually that they've got another competitor in the space, but you don't really realise how much demand's pulled forward. And with Enphase, it's that, you know, there was so much demand pulled forward that it's going to be really hard numbers for them to beat for the next kind of year. You know, it's going to take them a year to go over the tough comps, and then after that you're looking at another year down the line and going, how much demand's being pulled forward? Are they going to have another year of flat growth? And that's a really tricky thing with Enphase now, is that we don't know how much demand's pulled forward and how much is high interest rate sensitive. But it's a double combination, and that's what's making it look really ugly out there. And that's why it's really hard to value this stock at the moment, because we don't know where it's going to settle in a year's time. I mean, if you look at Enphase's numbers, I mean, they were so ugly. You know, you look at the, I mean, EPS was in line. They're doing quite well on managing like the gross margins. They're not like discounting that much. They're just kind of going, you know, we're just not going to manufacture as much. So the EPS is actually doing okay, but I mean, the revenue was down 13% year over year, missed by 13 million, and that's after a big downgrade on the last quarter. And this is where the scary thing comes in. So if you look at the guidance that they actually gave, I had to double check that I was reading this right. So they expected the revenue now to be in the range of 300 million to 350 million. And I was like, is that 100% the revenue guidance they're giving here? Because just to kind of put that into context of how far that is below expectations, analysts for the next quarter are actually expecting 600 million. That is massive. I don't think I've seen a company ever come that low on expectations on revenue basis. They're expecting half the revenue. I mean, that's absolutely brutal, and that is going to hit the profit line in some way. And then you're starting to think, well, next year, analysts are currently forecasting, you know, and they're only expecting 17% sales growth decline. It's, you know, it's going to be over 50% decline from last year. And then you're looking at analysts, and analysts are expecting 10% sales growth or 12% next year. No chance. No chance they're doing these numbers. Analysts are really going to have to update these numbers. We're talking about next year, we're going to see revenue not even flat. We might even see revenue down. You know, if we do see a rebound in the back end of the year, maybe interest rates start coming down and they do start improving. I mean, realistically, we're going to see revenue probably down. That's current year. Next year is 10%. You know, realistically, we're going to see revenue down at least 20%, more than likely. And that's a big downgrade. That's a big downgrade. And it comes really hard to value this company because that's going to drag the revenue down. That's going to drag the profit down. And, you know, we were talking about Enphase and, you know, people will start going, oh, at $96 it's cheap. At 24 times earnings it's cheap. It's not. Because the revenue is going to come down so much. The profit's going to come down so much. I mean, realistically, this is probably now going to be trading at a price to earnings right now of, you know, 70, 75. And then you're going, well, it's not cheap anymore. You know, this is a really hard thing, is actually trying to work out what the actual profit and revenue is going to be and what the growth is going to be in the longer term. Because where analysts are at right now, the company's nowhere near there. The company's down here. So the analysts have major updates they need to do on their forecasts at the moment. Major updates. That's the really tricky thing. And it's not good. It's not good for Enphase. I think the stock is in for big pain. I'm already surprised the stock's not down more than 20% today. I would expect the stock to be down 30-40% today. Massive day down. And for me, I talked about that if I saw Enphase going to the 70s and into the 60s, I'll consider it there. Realistically, I'm looking at Enphase and looking at the issues they have and the big slowdown that they're going on. And I think, you know, the catch up that analysts have to do is massive. I think this is, I think for Enphase, it's a sit back, watch, and at least wait until they get closer to hitting the targets. And then, even then, you've got to work out what the profit's going to be in the longer term, what the revenue is going to be in the long term, which is really tricky. I think this is definitely a stay off and watch for the next kind of couple of months, because I think they've still got at least another 2 quarters of big pain before we start hitting the bottom here. And I mean, realistically, when, you know, you've seen stocks get slaughtered, you know, you've seen PayPal get slaughtered, even though the profit's going up nearly double, the revenue's growing 7%, buying back 5 billion of stock. You know, I mean, Enphase, realistically, if they're coming out with the decrease in profit and the revenue declining so much, I mean, realistically, you know, what are we going to see Enphase go to? I mean, ultimately, I would say that we're probably at least going to see now Enphase go to pre-CV prices. I think we will probably see Enphase go to, I think we'll see sub 60 before Christmas. I think realistically we could see sub 40. I mean, we've seen so many companies that go to pre-CV level prices that I would not be surprised to see it touch those, you know, $50, $40, $30 range. I wouldn't be that surprised now. Because if they do those numbers, analysts are going to kill them and the share price is going to get killed on it. So, I mean, it's crazy to think that this only a year ago now was a $336 stock. You know, it's absolutely being slaughtered here. But I'm worried about them. I'm worried about where it's going to settle in the longer term. So for me, I just can't touch it because I feel like the downside here is still very high risk. I think that even, you know, when you look at the numbers that Enphase management are throwing out, you know, even though they threw the numbers out for the last quarter and then they delivered these numbers, without doubt, you know, the numbers that they threw out last quarter, they must have looked at them and gone, you know, we're seeing a big slowdown here, but we can't put those numbers out because we'll absolutely create the share price. I think even the management team are now putting out guidance that is to protect the share price. You know, if they're putting these numbers out, you know, it's very worrying that I think maybe they can go even lower than this. So yeah, it's ugly out there for Enphase, and for me, I'm kind of like, I don't want to touch this for another 2 quarters yet, because I think the next 2 quarters are still going to lap hard comps, and then we'll see where we're at, if they are closer to where analysts are forecasting there, and then maybe by then we'll have a better idea on a revenue and profit point of view, what we can work numbers off anyway. So yeah, hope you enjoyed the video, guys. If you could hit the like button, and I'll see you in a bit.